Good morning, ladies and gentlemen. My name is Raffaele Russo and I am the head of the BEPS project at the OECD. It is both a pleasure and an honor to address the conference of the Global Union's Committee on Workers' Capital, and I wish I had the possibility to be there with you live, but unfortunately that's not possible. What I'm going to talk about for the next 5 minutes is the context within which we are carrying out this project, the details of the BEPS project, and in particular the 7 deliverables that we have sent to the G20 for discussion at the meeting of finance ministers in Cairns in Australia, and then touch upon the relevance of all this work for long-term investors. So the context is a context of bad words, stagnation, crisis, budgetary constraints in many countries. And there is a recognition by governments globally that a system that is meant to avoid double taxation should not generate double non-taxation. Following a strong call from the G20, the OECD with non-OECD countries that are members of the G20 initiated the BEPS project. The BEPS project therefore brings all OECD and G20 countries on an equal footing to do what? To modernize the rules for the taxation of cross-border investments. The project was launched in September 2013 and it has a 2-year timeline, with a first batch of deliverables due for September 2014. What we have done is that we have now completed the first phase of the project, and all the deliverables have been agreed by consensus by all the member countries of the OECD and of the G20. What are these deliverables? There are 4 instruments, measures, and 3 reports. The reports basically are analytical reports on issues that needed to be evaluated in more detail. The first one is about the digital economy and the changes brought to the economy by globalization and digitalization. There was a lot of confusion before this report. Now there is agreement among countries that the digital economy can't be ring-fenced, that the BEPS issues, the base erosion and profit shifting issues that arise in the economy are exacerbated in the case of the digital economy, and that the actions of the BEPS action plan, 15 actions of the BEPS action plan, will put an end to what many refer to as stateless income, so income that doesn't pay tax anywhere in the world. The second report is about the feasibility of a multilateral instrument to amend in one go the network of bilateral tax treaties. Why? Because we are developing measures that will imply changes to double tax treaties as well as domestic laws. And in order to speed up the implementation, a group of experts has concluded that it is indeed possible to use a multilateral instrument to amend bilateral treaties in one go. The third report is about harmful tax practices. So not only aggressive practices put in place by taxpayers, but also by some governments in order to attract mobile capital artificially. There is nothing wrong with putting in place tax incentives in countries, but there is a problem internationally when these incentives are meant to only attract profits in an artificial manner and not substantial activities, or when they are given in a non-transparent, opaque manner. Then we have 4 instruments, 4 measures that will address some very specific issues in the context of international tax planning. The first one is draft rules on hybrid mismatch arrangements, so arrangements that generate, for example, multiple deductions for one single payment, or a deduction in one country without taxation in the other country because the same payment is treated differently by the 2 countries concerned. We have now agreement on the fact that these mismatches should be tackled, and we have agreement on the way to do that. The second measure regards treaty abuse. There is agreement among countries on the need for a minimum standard that avoids that double tax treaties are abused by interposing shell companies for the purpose of obtaining treaty benefits. The third one is about the transfer pricing treatment, where transfer pricing are the rules in order to price transactions between different parts of the same multinational enterprise. And we have now revised the guidance on the application of the arm's length principle, which is the international standard to determine these prices. We have revised the rules that relate to the treatment of intangibles, which is a key area of concern regarding base erosion and profit shifting. Finally, the fourth measure relates to the documentation that multinationals have to provide to tax administrations regarding their transfer pricing policies, both at the global level and at the local level. And part of this package of documentation includes an agreed template for a common reporting of information on a country-by-country basis. So tax administrations worldwide will have information about a number of indicia of economic activity, like the number of employees, the revenue, the profits, the assets that are located in each of the jurisdictions in which the multinational enterprise operates. Why is this relevant for long-term investors? Well, for a number of different reasons. First of all, because it will increase transparency. There will be much more transparency regarding the way multinationals manage their tax affairs. Multinationals have a different appetite for tax risks. There are some that are more prone than others to take tax risks. But very often it's very difficult from the information that is available today to know that. Secondly, and possibly more importantly, these changes, because they are agreed by a large number of countries, and in addition to the OECD and G20 countries, developing countries are also actively participating in the project, and their engagement will be institutionalized and strengthened going forward to make sure that the different measures take into account the specificities of developing countries, particularly as regards the administrative aspects of these rules. These rules are now agreed, and once the project is finalized, we will have an international tax framework that is based on consensus. This will provide increased certainty to business and investors, something which we very much need these days. Finally, something which is very specific to long-term investors relates to treaty abuse. We have crafted rules that, as I said before, prevent taxpayers from using shell companies in order to obtain treaty benefits and invest in certain countries. We at the OECD had already done work in the past regarding collective investment vehicles, and we will make sure that the rules to prevent treaty abuse do not negatively affect the work that had been done in the past in relation to collective investment vehicles. Ladies and gentlemen, as I said before, I would have very much liked to be with you there. I would invite you to challenge the other members of this panel with interesting questions, and look forward to hear from my colleagues of the Trade Union Advisory Committee of the OECD about the outcomes of the discussion, and continue the engagement with trade unions and other stakeholders. Thank you very much.